Thank you everyone for joining this new edition of the DigiShares webinar. This month, we'll be talking about real-world asset tokenization on Provenance, Polygon, the Liquid network through Blockstream, and Polymesh. So 4 great chains, and of course, the most senior speakers possible in each case. Thank you, Anthony, Colin, Adolfo, and Graham for joining. And we will start with Klaus, CEO of DigiShares, who will give us a short update. Then we'll go to our speakers. And at the end, in about an hour and a half, we'll have a short panel discussion, Q&A. So please participate in the Q&A. At the bottom of your screen, you can see the Q&A section, which is different from the chat section. So please participate in the Q&A section. The floor is yours, Klaus, for the intro.
Thank you very much. I hope that everyone can hear me. In fact, I have a poor connection here in the summer house at the beach, so I'll turn off video while I speak. I'm the CEO of DigiShares. DigiShares is a provider of a white label platform for tokenization of real-world assets. We have close to 200 clients in more than 40 countries, and we sign up 7, 8, 9 clients per month. In fact, September was a record month for us with a good number of new clients signed up, indicating that the tokenization market is growing. In addition to this, we are launching realestate.exchange, an exchange for tokenized real estate trading, initially in the US in November or December. We are also part of the European Union blockchain sandbox with the same project, so possibly launching in the European Union next year. We're also applying for a license in the UAE, so possibly launching also there next year. And then we are, together with a partner in South Africa, we are getting a license in to cover the African continent. So we are very much looking for assets right now. So if you have especially a US property, US asset that you want to have traded, have made liquid, get in contact with us for listing it on realestate.exchange in the US. We conduct these webinars on a regular basis every month. The next one is in November with a focus on the European tokenization market. Otherwise, I would say about today, of course, we are focused on different chains, all supporting RWA tokenization. Our platform is chain agnostic, but we support 2 of the chains presented today, and the 2 other chains are on the roadmap to be supported. There's been record interest for this webinar here with more than 230 people signing up. So we should have a lot of interest, a lot of questions today. And thanks again to the speakers. Polygon, of course, is a close partner with us on realestate.exchange. Polymesh, been working with these guys for years. We support that chain. We have got a few clients working on it already. Provenance is one of the biggest chains in the RWA space. I think they have the biggest total value locked. They're also on the roadmap for us. Blockstream is especially interesting for me as a Bitcoin maximalist. I'd like to tokenize something on the Bitcoin chain in the future. Looking forward to that. I'll hand it back to you, Gabriel. Thank you very much. Everyone have a good webinar.
Thank you, Klaus. So our first speaker, Anthony Morrow, CEO, Provenance blockchain. So Anthony, I'll let you briefly introduce yourself and start your presentation. Thank you.
Great, thanks. Can you see that? Does that work?
Yep.
Great. Okay. Well, thanks, Klaus and Gabriel, for the invitation. Happy to be here. My name is Anthony Morrow. I'm the CEO of Provenance Blockchain Labs. And I'll talk about how that is different from the foundation in a bit. But my background, like most in the space, I spent 20 plus years at BNY Mellon running various businesses there, including the depository receipt business for EMEA. After that, I ran a public REIT here in the US, listed on the New York Stock Exchange. And then I met the proponent of the Provenance ecosystem, a guy named Mike Cagney, who blew my mind on all things financial services related to blockchain and how we can completely remake the market on blockchain to be cheaper, faster, and safer than existing TradFi functions, and I was sold immediately. So it's been an interesting road to get here, but happy to talk through, Provenance blockchain and Prov Labs over the next few minutes. Great. So this works. I'll just start by saying, yeah, obviously it's no secret that today's financial services are built upon complex, time-consuming, and expensive intermediation. Most financial transactions require several service providers, and each takes a small fee to move the process one step further. Many of these things I helped operate when I was at Bank of New York. A lot of the intermediation is justified. For instance, separate accounts and exchanges and clearing agents and custodians ensure a proper audit trail is kept, and they reduce risk and increase control. And ultimately, all this intermediation exists to bring a redundant amount of trust into the financial system and protect investors from bad actors. And we've all benefited from that in our stock and bond trades, et cetera. But imagine if you could ensure that investors are appropriately protected while significantly increasing transaction speed and materially reducing transaction cost. This is the new value proposition of blockchain and financial services. Blockchain does two things particularly well. It doesn't do everything, as many people say. It does two things particularly well. It displaces trust with truth through an immutable public registry, and it enables real-time, riskless, bilateral transactions without intermediaries. Adoption is still in the very early stages, but we think it's inevitable that a properly built blockchain network that reduces intermediation, increases speed, lowers cost, and improves safety will materially change the industry and impact $12 trillion of existing financial services industry revenue. When the new financial system is cheaper, faster, and safer than the existing one, we think everyone wins, except obviously the guys who provide the intermediation. So I'm sure everyone will have this slide, but there are several estimates of the potential market value of digital financial assets, but all the pundits agree that opportunity is in the tens of trillions of dollars by 2030, as credit, bonds, funds, and other asset classes come on chain. And while all predict large numbers, they're all still just a fraction of the $700 trillion of investable assets in play over the coming decades. All of these assets will need to be ledgered, registered, and exchanged on public blockchain networks that support a diverse range of asset classes and issuers and investors, while acting as a good control location and mitigating risk across the network. So and this is the purpose of this call, which layer one blockchains will come to dominate this new industry is literally the multi-trillion-dollar question, and the reason we're all here today. We think the best approach is to look at existing traditional financial services for guidance, where we see from credit cards to custody banks, a global oligopoly of providers inevitably evolves due to security, interoperability, and regulatory pressures, right? We think we'll see the same dynamics in DeFi, and a very small number of public blockchains will be used to register, ledger, and exchange the world's financial assets. I certainly am not a believer in, there's not going to be 50 blockchains that are, operating in financial services. Maybe it's 4, maybe it's the 4 that are here today. It's still very early innings, and we'll see where it all comes out. Within this construct, though, we think Provenance blockchain is perfectly positioned. Provenance is a public proof of stake layer one blockchain built specifically for regulated financial services use cases. Our mainnet was developed with a unique hybrid model that offers the best attributes of the public permissioned, quote unquote, all purpose blockchains and the private permissioned DLTs, which are more focused on financial services. Simply, Provenance's structure allows it to benefit from public blockchain innovation and open source accessibility, while enabling the robust security and good control features that regulated financial services require. And moreover, while most financial services use cases are well suited for Provenance's public mainnet, as we know, many banks and large asset managers have specific asset protection requirements driven by risk compliance and regulatory pressures that preclude them from building on public blockchain networks. For these use cases, Provenance's private and permissioned zones offer the same APIs and capabilities as our mainnet, while allowing operators to have complete control over the permissioning and validators and tokenomics. Zone operators have seamless interoperability into public mainnet over IBC at the time of their choosing, which serves to future-proof builds and asset issuance. As a result of Provenance's specific focus, the network has grown to become the world's largest public layer one blockchain as measured by real-world assets, with more than $13 billion of value total locked, and more than 40 billion in financial transactions executed on the network. According to RWA.xyz, Provenance currently ledgers around 70% of all RWAs on all public blockchains. And as the RWA opportunity continues to capture increased attention, Provenance's leadership position, I hope, will only grow in importance. Provenance's superpower really is that that many financial services capabilities like governance, identity, privacy, exchange, and interoperability are built directly into our core protocol. Essentially, asset issuers can program all of the attributes that they need to meet operational or regulatory requirements at the time of asset creation. By materially reducing or even eliminating third-party smart contracts, Provenance significantly de-risks financial services applications and eliminates what I call the Jenga tower of risk inherent in some all-purpose blockchains. Generally, an all-purpose blockchain requires builders to integrate numerous third-party smart contracts to perform complex functions that facilitate their desired use cases, whether it's gaming or meme coins or the metaverse or regulated financial services. And as blockchain networks increase their focus on RWA and financial services, the landscape is getting a bit confusing. A proliferation of dozens of security standards on the EVM-compatible blockchains. Yeah, we all know of ERC-20, ERC-721, ERC-1400, ERC-3643, I think further stresses the system. And as each smart contract introduces complications, including counterparty risk, upgrade compatibility risk, cyber risk, and increased expense and vendor management. Having sat in more risk committee meetings than I care to remember during my 2 decades at BNY Mellon, I can tell you these complications do serve to hinder financial services adoption at scale. So Provenance's architecture more closely mimics the good control location inherent in TradFi custodian bank and brokerage networks. So some of the core capabilities built into the protocol include the first smart tokenization capabilities we call markers that offer issuers the ability to toggle on or off transfer restrictions, programmatic tendering, restoration in case of loss, escheatment, abandonment, and other functions that are required by securities law, again, directly in the protocol, not a smart contract. Data privacy is also an absolute requirement, as we know, for a public blockchain focused on financial services. And Provenance stores confidential data and PII, personally identified information, off-chain in what we call an encrypted object store, which is referenceable directly on-chain through encrypted hashes. Next, we know that identity is crucial in regulated financial services, and Provenance supports functions like KYC, AML attestation, signature authorizations, all directly on-chain with immutable records. Provenance's exchange modules are very unique in that they offer in-place escrow and execution, asset ownership protection, atomic settlement routing, which allows regulator required processes like unwinding of illicit trades or transactions. And then finally, Cosmos. Provenance is built in the Cosmos network. It's highly interoperable ecosystem, and a technology called IBC allows the ability to safely move financial assets between private and permission zones and into mainnet and vice versa. So Provenance has a material lead in financial services blockchain and a fast-growing ecosystem of diverse asset issuers, servicers, infrastructure developers, and protocol validators. The flywheel is spinning, powered by the evangelical passion of our network participants, which range from tier 1 banks down to early-stage fintechs. A bit of history: the network started when Figure launched its lending business in 2018, led by Mike Cagney and Juno. Figure Lending, which is now called Figure Technology Solutions, has since disrupted residential lending by building a Provenance blockchain-enabled home equity line of credit business that is now the largest non-bank lender in the entire US. Many of the home equity lenders, including their competitors, so it's a B to C to B business, so their competitors are all now using the system, including Movement Mortgage, HomePoint, Guaranteed Rate, using the Figure platform, issuing on Provenance. And in 2024, these businesses are generating more than $600 million a month in activity on Provenance, ledgering HELOCs. And together will account for more than 15% of all HELOC issuance in the US this year. This makes HELOCs the first and so far only asset class to be materially disrupted by blockchain. The Figure solution really showed the way for a blockchain-based business. The borrower-facing workflow has an intuitive internet-based experience with a blockchain-based middle and back office. If you go to Figure or Guaranteed Rate or HomePoint, you don't interact with the blockchain. You don't need a wallet. You don't need to hold crypto. You don't even know that you're interacting with a blockchain, and that's okay. On the other end of the origination, the securitizations that come out the other side are rated by DBRS Morningstar, and the bankers include Goldman Sachs and JP Morgan and my old firm, BNY Mellon. The primary blockchain benefits of the process are significantly increased speed of execution and material operational savings that are more than 150 basis points less expensive than the traditional process. When you're doing $600 million a month, that's a material amount of savings. The savings can increase profit to the lenders and both lower rates to the borrowers, so doing a bit of societal good. So coming back to my thesis at the beginning, once again, when transactions are cheaper, faster, and safer, everyone wins except for the incumbent intermediaries. The next business that has scaled here is Figure Markets, which is a Provenance-based decentralized platform focused on trading, borrowing, and investing in a range of assets. They've recently launched a new kind of decentralized exchange using MPC wallets for crypto, and are quickly expanding into other real-world assets like consumer credit, public equity, fixed income, and alt. And importantly, offering cross-collateralization across all assets as they build a marketplace for everything. And then finally, Prov Labs has just spun out of the Provenance Blockchain Foundation, and we're building a suite of foundational infrastructure SaaS products that enable asset issuers and servicers to efficiently transact on Provenance, and leveraging the roadmap and the institutional grade infrastructure used by Figure, JP Morgan, Apollo, and others to help asset originators scale quickly with a wide range of new use cases. Our first engagement got a lot of press. It was the latest iteration of the Monetary Authority of Singapore's Project Guardian. JP Morgan's Onyx digital asset team, in collaboration with Apollo and Wisdom Tree, enabled fund managers to tokenize funds onto private permissioned instances of Provenance and JP Morgan's Onyx platform, as well as a subnet of Avalanche. JP Morgan's wealth managers were then able to buy, sell, and rebalance thousands of separately managed account positions across the three interoperable blockchains according to their model portfolio allocations. The press described the project as the holy grail of capital markets blockchain, and they touted how this next generation solution could reshape the $5.5 trillion portfolio manager business and democratize access to alternative assets. The implementation was involved, but we worked closely with JP Morgan, Apollo, Oasis Pro, Axelar, and others. From private equity to debt to real estate, many fund asset managers across the industry saw Project Guardian as a compelling reason to digitize and now view Provenance, I think, as a leading industry standard blockchain. Taking a bit of a step back to the history, the Provenance blockchain was launched in 2018, again by Mike Cagney and Juno, and a private permission. After it was in 2018, it was a private and permissioned instance on IBM's Hyperledger. In 2021, it was rebuilt in its current form in the Cosmos SDK, and the Provenance Foundation was launched at that time. The network has been at the forefront of innovation since its launch, and some of the industry firsts include the first blockchain native consumer loan originations, the first asset-backed securitizations, the first rated asset-backed securitizations, the first blockchain native REIT, the first mortgages and HELOCs, the first digital asset registry, the first digitally native cap table, and the first bank-issued stablecoin. And then finally, we're excited about the first ever yielding stablecoin, which is currently on file with the SEC. And if approved, will be one of the most exciting blockchain products, I think, ever. So watch this space. Some network metrics on this slide show that activity in Provenance is growing every day. The third quarter of 2024 was by far the most active quarter in the history of Provenance, with record activity really across every operating metric that we track. Total fees paid into the network were up almost 50% year over year to $530 million. For the full year total was around $2 million, which for context is on par with many of the highest market cap layer one networks, Cardano, Hedera, each for context are around $2 million a year on an annualized basis. Transactions during the quarter were 1.1 million, up 5% or so year over year. And then, of course, the Provenance network ended the third quarter with $12.3 billion in total value locked, up more than $1 billion quarter over quarter and 30% year over year. And as I mentioned, all of Provenance's TVL is real world assets like credit and private company equity, insurance, and funds, making Provenance by far the world's largest blockchain as measured by real world assets. Our utility token is named Hash. Hash is used to pay transaction fees for staking and as a voting mechanism in governance. The hash price floats, and its value is driven by usage. There's a fixed supply of 100 billion, and it can't be created or destroyed. Of course, Hash is much less well known than many public blockchains and isn't listed on the popular centralized exchanges. Our community is almost entirely institutional, and there haven't been many real retail use cases yet. But the launch of Figure Markets changes this, and Figure Markets decentralized exchange is the first proper marketplace where users can buy and sell hash. And importantly, we announced plans to finally list hash on some of the more well-known centralized exchanges in the coming months. And we have plans to build visibility across traditional crypto channels in 2025. So again, watch this space. We've covered a lot in these slides, but we hope we came away with a good understanding of how Provenance has built a blockchain specifically designed for real-world financial assets. You can connect with us on email, Twitter, X, Discord, GitHub, LinkedIn, with any feedback or ideas. And we're building the new operating system for financial services and have great momentum, and it's been incredibly exciting for us. And we hope you learn more about our ecosystem or ask some questions in the Q&A. I hope I did well on time. Thank you for your attention.
Thank you so much, Anthony. And as a brokerage account holder myself with Figure Markets, I can only recommend their platform. Looks really great. Love the UI UX. And yeah, looking forward to see the next steps for you guys. Just a reminder to the participants that just joined, please participate in the Q&A section in your screen below. It is different to the chat section, so please use the Q&A section, and we'll have a roundtable panel type discussion at the end where we will read all the questions. So yeah, on to the, we just got a question in the Q&A. We'll take it during the panel discussion later. So we'll move to the next speaker, Colin Butler, Global Head of Institutional Capital at Polygon. Colin, the floor is yours.
Thank you very much, Gabriel. And man, Anthony, that was spot on. Like I feel like I should steal the first half of your presentation because it creates a really great argument for why financial institutions should be disrupted and disintermediated by blockchain. I couldn't have said it better. So thankfully, I didn't use my slides because it wouldn't have been as good as that one. But I'm happy to give the kind of slice of the pie that I think Polygon offers to the value proposition for blockchain. And I guess before I do that, just as a quick note of introduction, so I run the global institutional capital team at Polygon. What that does is it actually does largely center around tokenization. So very much core to this webinar. And so far, you can think of this in terms of like tokenization of financial assets. As Anthony mentioned, we also share some use cases with JP Morgan, Hamilton Lane, Franklin Templeton, and Siemens, a host of others. And I think the core focus for Polygon, as differentiated from maybe the rest of the folks on the call, is really it represents a suite of Ethereum scaling solutions. And the reason why Polygon is really focused on Ethereum, I'll actually get into in a little bit more detail in a couple minutes. But I think the key to the building the foundation is really where Polygon started, how it evolved, and what its focus really is. I think it started and it gained what I would consider sort of mass adoption among almost retail, as opposed to kind of what Anthony was really focused on as their core starting participants in their ecosystem is really institutions. Polygon almost took the opposite approach. And it started really almost at a ground level. There is just a swell of a global crypto community of, I would argue, retail users in the millions on the Polygon blockchain. And so the reason for that was less about the specificity of the technology. It was more about the generality. So what I mean by that is why people adopted originally was that it was something that was very stable and it was easy to use. And that was it. It wasn't magic. It was just something that could be counted on to record these transactions on a distributed and public ledger. And then secondly, it was cheap and fast. And those are kind of the table stakes for blockchain that evolved starting probably 4 to 5 years ago. Those are things that everybody has to have it at a minimum at this point, just to really be thought of as a reliable layer and call it like a top 10 participant in one of the major blockchains that Anthony highlighted that would be the foundation for this potentially gigantic industry as financial services and traditional finance especially come on board. So once you're past the basics, right? Cheap and fast, very reliable, easy to use, easy to build on, you get to the point where you're really focused on community building. And that really plays into liquidity. I think the challenge with a lot of these ideas is that if you don't have a large pool of users, then you're really constrained in, let's even assume you have an amazing use case. You're really constrained in what you can do because call it nobody knows about it. They don't have the right tokens to use the network. And so what Polygon really focused on and did, I think, very well was building this global community. Polygon actually has the second largest community outside of Ethereum, at least in terms of developers. And then the metrics around daily average users and things like that are also very, very strong, kind of competitive among, call it like the top 3. And ultimately, as I mentioned, leading to a community of millions around the globe. So when you combine the Ethereum community with the Polygon community, I would argue that you have a core of liquidity. So when you get a DigiShares that creates a new platform for a market like real estate, potentially one of the largest markets out there, that DigiShares is really the clear leader, you can combine a massive global community of users with a best of breed product. And what the hope is that you get natural and organic adoption through that network. I do believe crypto, my guess is everybody on this call also, or let's just say blockchain. I do believe blockchain is an industry of network effects. It very quickly becomes a place where people go to where, for instance, marketplaces are network effect reliant, right? The buyers go to the place where there are the most sellers, there's the biggest depth of book, there's the least amount of spread, where they have the greatest selection. So what you really need is to co-locate those folks essentially in the same room. The place that you bring all the buyers and the sellers is going to be the largest marketplace, which begets more buyers and sellers. And then eventually you get to kind of like a Facebook-like effect or a Google effect, whereby that just consolidates the lion's share of the market. We actually believe DigiShares could be that for real estate. So Polygon is super excited to collaborate with DigiShares on the upcoming initiatives and into the future. And I think what we hope to bring is really the connectivity to that ecosystem. So far, in terms of institutional adoption, Polygon is among one of the top tier chains. And what I'd like to see is the ability to connect those institutions that are already within the ecosystem to the DigiShares ecosystem and just create a much, much bigger pie for everybody. I love that Anthony shared the TAMs, right? The total addressable markets. There's a range of estimates for most people use 2030 as kind of a benchmark. I tend to use the $16 trillion number by the World Economic Forum. I think they're super credible. They probably have as good a guess as to the future as anybody, given that it's essentially impossible to predict the future. But out of that 16 trillion, you can imagine there's a huge share of that gets tokenized via the real estate markets. So again, if DigiShares is the leader in that slice, you can envision a scenario where there's trillions of dollars on chain. And what we think you need to have from a blockchain perspective in order to enable those $1 trillion is actually a couple things. And this is really where the differentiation comes in and where the Polygon roadmap maybe diverges from others. We think you need a couple things. One, it's ultimately for us, it's settlement to Ethereum. So Ethereum has by far the highest security guarantees of any network, with over 1 million validators at this point. So for us, we envision a world that uses Ethereum as a global settlement layer, and everybody else ultimately feeds into that. Because if you're talking about moving and securing trillions of dollars, and to start, it would be billions of dollars, think coming through the large traditional financial institutions like BlackRock. If you're going to be moving billions of dollars across the blockchain and settling on chain, you really need that gold standard for security, which is it's literally orders of magnitude higher than the security provided by other chains. So we're to some degree Ethereum maxis, where we believe that should be the world's global settlement layer. And then the things that you also need in addition to that to create this, call it $16 trillion market by 2030, are unified liquidity. And we also believe security based on zero knowledge technology. And for us, what that means is the ability to unify all the siloed liquidity from all the chains. Think all the other public chains that are not on the call. Think about Avalanche and Solana, and make it a situation where all of their users can play into this global ecosystem that's unified by zero knowledge technology, which is currently, I would call it the best of breed or gold standard for interoperability security or interoperable security. And what that does is hopefully it unifies the liquidity for all the space. What you can't have is a specific platform that has some shred of the liquidity and then a bunch of other platforms also silent with islands of liquidity that doesn't yield the network effects that crypto needs for the kind of rocket ship style adoption that we all want to see, right? We all talk about how do we get to the first, call it the next 200 million users. How do we get to the next billion users? Part of that, what I would argue maybe the most difficult challenge to solve for is actually liquidity. And so I think for the Polygon roadmap, that's almost everything. It's really, how do we bring Provenance's assets into, or how do we give the most amount of users access to the assets on specific chains? So for us, it's really going to be in the near future, not about how do we build the biggest community as Polygon and continue to develop that flywheel, but it's really about how do we bring in all the communities? How do we bring all the communities of blockchain together in the way that we can unify liquidity, gain unlimited, infinite scalability? So when you do get the large players coming into the market, the depth of liquidity is there for them to actually participate, as is the security. So I think I'm going to pause there. I look forward to answering questions on the Q&A, and I will turn it back over to you, Gabriel. Thank you for the time.
Thank you so much, Colin. We have a question that we're going to save for the panel fireside chat discussion at the end. I do want to discuss during that discussion, during the panel, what you said about the security aspect, Ethereum providing the highest level of security. I'm guessing Adolfo has maybe some comments about that, so I would love to see a debate between both of you on that topic. And so perfect transition, actually. So we have Adolfo Contreras, strategic advisor, Blockstream. Blockstream enables you to tokenize on the Bitcoin Liquid network. So yeah, the floor is yours.
Thank you very much, Gabriel. Let me share my screen. Hope you can see it now.
Yes, we can.
Sure. So thank you very much, first of all, for the invitation to speak. Well, I think that I'll speak about these two first points, and then if there are questions, we can delve into the use cases because time is limited. First, explaining that, well, Bitcoin, of course, we didn't raise money with a native token because we use Bitcoin as a native token on Liquid. And the way we see this is that we use a layered approach because we believe that blockchains have trade-offs, right? You cannot increase scalability. You cannot enable advanced financial applications without compromising decentralization or security, and therefore we believe in a layer approach. And this means that the valuable token needs to be in Bitcoin, in the layer 1, bottom left in there, with the maximum security and no compromises, basically focused on security, things that have been working for 15 years. Again, yes, I disagree with Colin that Ethereum is the most secure, but that's another conversation probably. And then we believe that advanced financial applications and scalability and throughput can be built on second layers, right? And then Liquid is such a thing. Liquid is a sidechain to Bitcoin, and it enables through two-way pegs to use Bitcoin with different protocol rules, with digital asset issuance, with stable coins, with any kind of financial asset. Then there's Lightning Network that works for both Bitcoin, but then also for liquid assets to enable maximum throughput whenever that, for example, for stable coins or for any other assets that require such big transaction throughput. I think it's interesting that since we didn't raise that money with a native token, I thought that some years ago that used to be a disadvantage, but now I believe it's an advantage because we've been focusing really on solving problems. And the problem that we think a blockchain solves the most is basically enabling trust where there is no such thing. I mean, it's true that in the EU or in the US and Western countries in general, there is efficiency gains, right, by using blockchain. But that is a bigger way advantage to do this in emerging countries where there are no such trusted intermediaries. You know, by using a blockchain, you can connect a reputed institution in one of those countries, like a law, a regulation that enforces rights over a particular valuable asset, local asset, and then connecting it with global investors. And this is the kind of use cases that are growing on the Liquid network, and we want to keep that momentum and strategy moving forward. How tokenization works? Well, first saying that these are the three characteristics that we believe where we believe Liquid excels. I would add also the trust minimization philosophy that some of my colleagues are some of the most prolific Bitcoin Core contributors. So the trust minimization philosophy is essential if you want to enable and security are essential if you want to actually replace those trusted intermediaries that don't exist in those emerging economies. So Liquid is a federation open source settlement network that enables investors and issuers to issue, custody, and exchange digital assets. So what I mean by this is that Liquid is managed by a federation. And I think this is an important point because most of these trusted intermediaries, like a national stock exchange, like a clearinghouse, a central security depository, even central banks for the settlement, are actually federations of members. And what we are doing with Liquid is basically replacing all of them with just one federation of companies that have aligned incentives. I think it's also important to mention that in most blockchains out there, I think there is a conflict of interest between participants that want to maximize the value of their native token and those that want to enable high-value financial applications. Instead, by having a layer approach, on Bitcoin, you have the people that want to maximize the value of that token, but then on Liquid, you have the people that only want to enable high-value financial applications. And I think this is a very good advantage in terms of stability of the network in the long run. Besides, the federated consensus model is the most proven one in the financial industry, right? It's been out there for many, many years. Liquid enables issuers to enforce their own compliance, regardless of their country of jurisdiction where they're issuing from, basically through what we call the asset management platform. It's an off-chain logic that you can add to the transactions through an API. We think that it doesn't make much sense to do the regulatory logic on chain because it's a regulation logic by default is centralized, right? So it doesn't make sense to decentralize a centralized service, right? So all this logic happens off chain with this asset management platform, which is basically a set of APIs that create white lists and black lists, and therefore only the transactions that go through all and that get approved by all those white lists get through to the next investor. Asset issuers can perfectly audit and enforce investor compliance without needing custody peer-to-peer. I'm a happy user, and I exchange securities with other investors peer-to-peer from my cell phone using a hardware wallet. But of course, there are third-party custodians that do so for their institutional customers. In real time, you can prove total quantities issued and burned without disclosing investor holdings. And this happens with just a click of a button. Investors in Liquid can trade multiple assets. The settlement is finalities in 1 to 2 minutes. And the reason is that with federated consensus, there are no reorgs. And therefore, the finality, you can be sure that it will be in at most 1 to 2 minutes. I have to also say that Liquid is an implementation of the Elements code base, which means Elements code base is an open source project. And Liquid is just one implementation of the many you can do with customized parameters. So we have a number of projects that are catering to different use cases, namely payments in emerging economies, enabling circular economies, where what it's being used is a sidechain different than Liquid, but also an Elements code-based sidechain. So they are all connected and also connected to Bitcoin, which is, after all, the largest digital liquidity pool. The assets are confidential by default, and they have been like that flawlessly for the last 6 years, and they can be selectively shared with regulators whenever that's the case. So nobody has visibility over the asset other than the investor himself and whoever he shares his unblinding key with. For example, a regulator, if there was any a mandatory rule to do so. I think that it's important to mention as well the multi-signature and that are supported natively because Bitcoin Liquid uses 85% approximately of Bitcoin's code base. So we rely on the robustness of Bitcoin, to take, and we are basically some opcodes and logic, internal on-chain logic to enable these advanced financial use cases. Besides, liquid assets are used as collateral, and currently more than $400 million are being used by U.S. banks and U.S. funds through a loan manager out of Mexico, basically promissory notes. This is a use case that is growing a lot from there, and we have a big pipeline coming from a number of other LATAM countries. A liquid network, again, uses no proof of work. It's federated consensus. No staking tokens to power consensus are needed because, again, the consensus model is federations, which is the most proven one in traditional finance. Nobody has visibility over confidential transactions, and as I said, the consensus logic is inherited from the Bitcoin code base. The 80+ members that conform this federation are divided in 3 boards, and they take technology oversight and membership decisions. So we think that Liquid has a good balance for capital markets between the decentralization that is needed so that nobody needs a central authority to take decisions, but also the centralized nature that enables further scalability than Bitcoin does. This is, let's say, a helicopter view of how it would work. Network, a subset of those 80 members are what we call functionaries that in other blockchains are called validators, and they sign blocks enforcing transaction ordering and validity. That's their only role. Then the AMP server, this policy server that I mentioned earlier, the asset management platform, enables issuers to enforce those rules for any kind of financial asset, and then on top, any third-party custodian or a private individual can exchange assets with each other, either regulated or unregulated ones. I think it's also, I have 3 slides covering the stability, the security and confidentiality aspects, because I think there are not very generally known out there. The advantage of the UTXO model compared to the account-based model is very important with regards to this trust minimization that is needed to grow liquidity coming from those countries where trust is a problem. And therefore, avoiding problems from account-based model chains where the reordering of the transactions doesn't not happen until I like to explain it in this way. With coins, physical coins, if you're exchanging physical coins, there is no doubt who has exchanged what coins, but and therefore there is no invalid transaction. But with a bank account, the reordering of transaction is quite a thing, because if you don't have a balance when a transaction is getting out, the transaction can be deemed invalid. And this is actually the case in account-based model chains. So for example, this piece of data from March 2023, output to 2.7% of the transactions in Ethereum were confirmed despite being invalid. So this has a number of cascading consequences, and one of them, for example, is the problem of MEV, which is almost impossible in a UTXO model blockchain. It is also impossible because the confidentiality exists, and it's easier on a UTXO model blockchain. With regards to the, let's say, security, the problems with not supporting native multi-signatures are, for example, this parity hack that happened a few years back. And it has to do with the way smart contracts work in Ethereum, which have single points of failure, as compared to the way the multi-signatures work on Bitcoin. So again, I disagree with regards to the security. We've seen multiple cases where security has been compromised on Ethereum chains, and this has not happened on Bitcoin or on Liquid. And then an additional feature, and I'm glad to announce it here, is that we have recently released the first formally verifiable smart contract programming language. Since we are, again, focused on trust minimization to solve the trust problem, what we have done is the UTXO model enables us to, or whoever wants to program with this programming language, to build smart contracts that are formally verifiable. That means that mathematically you can be sure of the outcome of the computation. So this means that you won't need auditors. You can basically compute in advance and know that the outcome of that computation is going to be as expected. And this is important in this kind of jurisdictions that don't have the legal enforcement capabilities, to name these kind of companies, auditors, and all these trusted intermediaries that make things happen in the EU or the US. And then the last part is privacy. Again, since the UTXO model disaggregates information compared to the account-based model, confidentiality is way easier on Liquid, so or Bitcoin too. So we've been using zero knowledge proofs for already 6 years flawlessly, and we even have plans to build now to issue and implement a proofs plus that will enable a decrease in 80% of the size of the transactions currently going on Liquid. And this is very important for financial markets. I think that if you want to enable, let's say, decrease the chances of MEV or sandwich attacks or investor from running, privacy has to be there by default. This is the TVL on the Liquid network. Since we started identifying some of these use cases coming from Latin American countries, and the let's say pipeline is growing constantly. So I encourage you guys to keep looking at the Bitcoin space, because I think we will have a very nice news coming up shortly. I think that's it. Yes, indeed. So happy to take questions, and thank you very much. Over to you, Gabriel.
Thank you, Adolfo. We have 2 very specific questions for you that I'm gonna ask you now. One is, how does Liquid differ from Taro?
Yes, Taro is enables the transfer of assets on the Bitcoin layer 1, which means that these assets cannot be regulated, because you cannot enforce regulation rules on the Bitcoin network. You can, for example, enable the transaction of stablecoins, and that is a nice use case. And if the security model lets you accept zero confirmations, that's probably a very nice, interesting use case for Bitcoin. But it's totally different. Regulated assets will not work on the Bitcoin network. You will not be able to enforce those rules. This has to be happening on these layer 2s like Liquid.
And another is, how does Liquid prevent rehypothecation?
Yes, it is always cryptographically proved that there are the same amount of assets that have been issued. And you can always be sure of the investor holdings of each investor. So you can always add them up and cryptographically prove that there is the same amount. So no assets are being used for rehypothecation in any way.
Understood. And there's one question that just came in someone's trying to understand the volume of transactions on Liquid network compared to Ethereum. Do you have any data?
Yeah, it is tiny compared to Ethereum, to be honest. With the use cases that we've seen, it always grows whenever there are high main chain fees. But again, we haven't been, since we didn't raise money with any native token, we haven't been able to build that community that Colin mentioned. So we don't have that kind of community building, and the use cases have been growing a lot with regards to assets that are being currently used as collateral. But unfortunately, those collaterals don't move much, right? So transactions haven't been great in number.
Perfect. Thank you so much. We will move to the next speaker, Graham Moore, head of tokenization at Polymesh. When I was first learning about this space in 2020, Polymesh and the Polymath guys, including Graham, played a big role in that with all of their content. I encourage you to follow their YouTube channel, and yeah. So thank you to Graham and to your team, and the floor is yours, Graham.
Thanks, Gabriel. I appreciate it. Yeah, so hi, everybody. As Gabriel said, I'm Graham Moore. I'm the co-founder and head of tokenization at the Polymesh Association. where we build tools like the Polymesh blockchain. And today I'll try to give the pitch for why Polymesh. Why should you build on Polymesh? Why should you use maybe DigiShares platform to issue an asset on Polymesh? Or why should you check out one of our other products called Polymesh Private? And so I'll talk a little bit about the history. A couple of the other speakers talked about it as well. But the way we see the space and how we got started is 2015, ERC20 comes out, so you can create a token on the Ethereum blockchain. You can send and receive, but that's about all you can do. Then 2017 rolls around. Companies like Polymath, which I was a part of as the first employee, Securitize, TokenSoft, Tokeny, these kinds of companies start saying, okay, well, how can we take something like ERC20 and how can we make it work for financial securities? So all these companies started building their own proprietary standards. We built ST20. I remember Securitize is called DS. TokenSoft and Tokeny had their own as well. And so we were thinking about how can we extend ERC20 for actual financial securities? How can you have, a whitelist to say this person can hold this asset, this person cannot? How can you do things like volume transfer restrictions and all the weird little things that you need to do to actually have financial securities? So we started building those. At Polymath, we built the first point-and-click interface. So any non-technical user could go click some buttons and create a security token on Ethereum. In 2018, we spearheaded a standard called ERC 1400, which a lot of people might be familiar with, which was really an umbrella of standards, again, for financial securities on Ethereum. And as we were building that, we got some good traction. Consensus announced that they were using ERC 1400. BNP Paribas, they used it for a bond issuance. The government of Norway supported ERC 1400. There were a number of different companies and countries even that were surrounding around ERC 1400 and saying, okay, this is a good standard that we're going to use on Ethereum. But as we were building that and as more people were adopting it, our tech team just kept saying, you know what, we just don't like Ethereum. And a lot of banks and a lot of custodians and a lot of other regulated entities in the space just kept saying to us, we don't like the Ethereum blockchain, specifically for the regulated asset use case. Now, that's not talking about DeFi, it's not talking about Bitcoin, it's not talking about ETH, the asset, but just for regulated financial securities. We just kept hearing that there were time and time again a bunch of issues with Ethereum itself. And that's what our dev team found as well. And so the way that I like to talk about this, and it's an easy way to visualize, the internet started on phone lines. Why? Because phone lines were there. They were already plugged into everybody's house. And so you run the internet on phone lines. But then as more people demand more upgrades, they demand things to be faster. They want to watch videos on the internet. They want to do all these new things that require a lot of bandwidth. Everybody gets fiber optic cable installed in their houses. And so the internet moves from phone lines to fiber optic cable. We think a similar thing is happening in the world of securities on blockchains, where everyone starts on Ethereum just because it's the biggest place. It's the biggest smart contract blockchain that exists. It's where all the developer interest was. It was where all the ERC20 utility tokens were. But then as you start building on it, you notice, okay, well, this isn't really good about Ethereum. This other thing isn't really good about Ethereum. And more people are demanding all these upgrades. And so we said, instead of trying to shoehorn in protocols on top of the Ethereum blockchain, which was never really built for financial securities, let's just build a blockchain specifically for this one use case. And so that was Polymesh. It's a purpose-built layer one blockchain specifically for securities. We like to talk about key pillars for why we built it. Governance is a big one. And an easy way to illustrate this, let's say you have $100 million worth of securities on Ethereum, or let's say you even have eventually $10 trillion of securities on Ethereum. And then there's a contentious hard fork where Ethereum splits into Ethereum A and Ethereum B. Well, that already happened with the DAO hard fork a long time ago. There was even a fork recently when Ethereum went to proof of stake, where Ethereum proof of work is still alive. If you have $100 million of assets or $10 trillion of assets on the Ethereum chain, and that happens, well, which chain are your assets on now? Are they on chain A or chain B? And the answer is they're kind of on both. But that's a huge question mark for a lot of institutions. Do you pause trading for your $10 trillion of assets and wait to see how things shake out? Do you let Vitalik tell you which chain is the real Ethereum? So a lot of question marks with that, which a lot of asset managers and a lot of custodians, a lot of banks, they just don't really like that. So on Polymesh, there's always one canonical version of the chain. Polymesh has identity embedded into the base layer. So actually to use the Polymesh blockchain, you have to pass a KYC process. And then on top of that, all the node operators have some kind of financial license. So those are, broker dealers, ATSs, exchanges, someone with some kind of financial license. And the reason we did that is because we just kept hearing time and time again from banks, from regulated institutions, if I make a transaction of $100 million bond on Ethereum and I pay $5 in gas, I might be sending $5 to North Korea. Now, that might be changing now where some people are comfortable doing that, but it's just still, again, a big question mark. And we were thinking, how do we build a blockchain specifically for these regulated use cases? Compliance is a big thing for us, where all we care about is financial securities. We do not care about the next Web3 game. We do not care about the next dog token that everyone's talking about. All we care about are securities. And so all of the compliance functionality, all of the asset creation functionality is embedded into the base layer of Polymesh. And so whereas initially we started thinking, how can you build compliance on Ethereum? Well, it has to be this kind of second layer protocol. We baked that all into the base layer of the Polymesh chain, which makes things more scalable. And it also helps with some stuff I'll talk about later in the presentation in terms of how different parties might have to interact in a blockchain landscape when you're creating assets, managing assets, and trading assets. Confidentiality is a big thing for us. So we have a very exciting hire recently who built one of the first confidentiality protocols on blockchains, where it's a big thing for us. And this is what every bank is talking about right now is, okay, how much information can I obfuscate in the transaction? And so I believe at this point on Polymesh Private, which is our private version of Polymesh that I'll talk about a bit later, you can obfuscate some of the information, right? But so we're getting to how can you obfuscate almost everything while still having a public blockchain that other parties can verify in terms of what is the state of the world. And finally, settlement's a big one for us, where on Ethereum, for example, and I know I'm picking on Ethereum, but it's just kind of the easiest thing to pick, and everybody knows it. I still love Ethereum, don't worry. But for settlement on Ethereum, if I find out your address, I can send you anything I want anytime. You cannot say no. So if anybody saw when BlackRock announced their BUIDL fund, a ton of people sent them, dick pic NFTs. They would send assets through Tornado Cash and then send them to BlackRock. So now BlackRock technically should be sanctioned by OFAC. And so just a lot of weird questions when you have a settlement infrastructure on a blockchain where you can't say, no, I don't want this transaction. And so on Polymesh, we built settlement the way every financial institution understands settlement, which is party A and party B in a transaction, sender and receiver both have to affirm settlement instructions, and only then can the settlement of an asset take place. And so, right, these 5 key pillars, just how do you build a blockchain specifically for securities? Custody is a very cool thing on Polymesh where I believe it's the only blockchain, and I know there's some other blockchains on the call. Happy to debate this, or maybe you've created something that we were unaware of at this point. But Polymesh is the only chain where you actually have the ability to delegate functionality to a custodian. So you can say, I am the ultimate beneficial owner of this asset, but this other party can actually send, receive, do other things with it because I trust them as my custodian. And so how this works on other blockchains is that you actually just have to build a second layer protocol, like what we were doing on Ethereum with ERC 1400, or you have to have some kind of centralized infrastructure where the assets are actually sitting inside the custodian, then the custodian writes in an Excel spreadsheet, hey, this is the actual ultimate beneficial owner. You can do that on chain on Polymesh. We're working with a number of companies in a number of different countries here for this. Of course, DigiShares is on there. Thanks for inviting us to the webinar. A number of other companies we're working with. Retokens is probably the most exciting in terms of assets that have been issued to date. So they've issued $30 million in real estate assets in the United States. They tokenized the first church ever in the whole entire world. So that was cool to see. You can go Google tokenized church Polymesh, and you'll find that as in Forbes, Cointelegraph, a lot of other different publications. Everyone was pretty excited about it. First ever tokenized church in the whole world. A number of other companies here that we're really excited about working with. And DigiShares, I think we're pretty close to issuing our first assets. So we're very excited about that. The GFMA, BCG, and BCG I think is who created that 16 trillion in tokenized assets number. Clifford Chance, which is a large law firm, and Cravath, Swaine & Moore, another large law firm. They put out a report recently, which was pretty interesting to read. They only talked about a few different protocols for creating tokenized assets, the usual suspects, Bitcoin and Ethereum, and then the private blockchains like R3 and Hyperledger. And then the only other blockchain they included was Polymesh. So that was cool to see, getting some nice recognition for our hard work there. But right, it's 2024. Where are the tokenized assets. Some are on Provenance, there are some on Polymesh, there's some on Polygon, some on Liquid. But we're all excited about that $16 trillion number. When's it going to be $100 trillion number? Where are they? Why are we still in the billions mark? We see this as a huge impediment to adoption. So the BIS pretty much tells banks everything they can and cannot do. If you read the parts in bold there, so this is from a report in 2023. I think they're still somewhat in the process of finalizing this. This is how it looks like it's going to shake out, where they have concluded that totally permissionless blockchains, right? And so Polymesh is a public but permissioned blockchain. Totally permissionless blockchains give rise to a number of unique risks, which cannot be sufficiently mitigated. And it's primarily due to their reliance on third parties to carry out basic operations. And so you could view that as the node operators are unknown, but we also view that as using third-party smart contracts to create, manage, and trade assets. So how we've read this and how we've talked to a lot of banks and talked to a lot of custodians is we see this as a bank cannot create, manage, trade an asset, and then develop a book of, let's call it, $5 trillion, $10 trillion of assets, and have the code base being run by, 5 people who happen to create a standard on Ethereum. That just really doesn't work when you're dealing with critical financial infrastructure. And so that's one of the big reasons why we, one, made a permissioned blockchain, but 2, also have all of those functionalities baked into the base layer of the chain. So a bank, a regulator, a custodian, an asset manager, they have to vet Polymesh, the blockchain. They don't necessarily have to necessarily vet and then monitor Polymesh plus other random entities who have created standards for smart contracts. And then what it really comes down to is, yeah, you can use a permissionless blockchain. You can use a smart contract heavy blockchain to do any tokenized real world asset stuff. But then what you're going to do is you're going to have a risk weighted asset add-on associated with any of the assets. So if anybody knows how BIS works with their group 1 assets and group 2 assets, crypto assets right now are considered group 2. So you can only have something like 1% of your capital base in group 2 assets. But even if they decide that crypto assets that are tokenized assets that are treated the same as securities, even if they're group 1, you'll still have to add on this sort of penalty for any assets that you have that are tokenized. And it's because of the dangers of dangerous quote, I don't think it's a danger, but the BIS says danger in permissionless blockchains that are smart contract heavy, right? And so maybe the world eventually goes there, but it's nowhere near there yet. And so that's why I think we've seen a lot of proofs of concept, a lot of fintechs issuing a lot of assets out of the capital base, but we haven't seen any bank come anywhere close to doing something like 5%, 10% of their capital base, because they have to add this sort of penalty. And so if you're saving, let's call it 5%, 10%, even more by switching to a blockchain-based system, but then you have to pay a 5 to 10% penalty to use it, it doesn't make any sense. And I think this is a big holdup and something that people aren't talking about enough, where why haven't we seen, the trillions of dollars of assets? I think this is a big reason why. And also, it's a big reason why we actually built Polymesh private. And so ultimately, higher capital requirements and limits for group 2 assets and even risk add-ons for group 1 assets make permissionless infrastructure that's smart contract heavy and non-starter for institutions. And so we think the solution lies with an API-driven blockchain, and that has to be a permission blockchain where there's native functionality for asset creation and management and trading, and you don't have to rely on third parties or changing standards, right? There's constantly a new standard on Ethereum. There's a new company creating, we did ERC 1400, and then Tokensoft or Tokeny did 1404, and now there's 1637, and there's 3403 or whatever. It's constantly changing, and banks and regulators really, really hate that. So instead, pick a blockchain that's API driven. You don't have to rely on smart contracts, and regulators can vet this one piece of technology rather than relying on tons of different parties. And so we did announce this earlier this year, where we now have a private version of the Polymesh blockchain. And so, myself being like a blockchain maximalist, I know we've heard people be Bitcoin maximalists and Ethereum maximalists on the call. This might seem like a step backwards almost, where people were talking about kind of like blockchain, not Bitcoin, 5-10 years ago. But now everybody realizes it's all about Bitcoin, it's all about tokenization and public blockchains. But given where the BIS is at, given where regulation is at, given how slow banks are to adopt new technology, a lot of the assets just still exist in private blockchains. And so how we see the world shaping up is a lot of the assets will still live on private blockchains for now, for the foreseeable future, for the next year, 2, 3 years. And what banks are doing is they're using tools like Onyx, JP Morgan's Onyx, they're using Hyperledger, they're building their own internal private blockchain database systems. But eventually banks and asset managers and custodians do realize that public blockchains are the future. But so what happens when they try to make that switch? Well, right now they're going to have to rebuild their entire tech stack from the ground up. They have to plug into a completely different blockchain. They might have to rewrite smart contracts into a different language. They might have to, scrap every single thing they built over the last 10 years when they make the switch to, let's say Polygon. Colin, I'll throw you a bone and say that everybody's going to migrate to Polygon, right? And so we think that doesn't really make a lot of sense. And so what we've said is, well, let's give these banks, let's give custodians, let's give them the option to use a private blockchain. And then when they're ready to move to a public blockchain, they can go from Polymesh private to Polymesh public by switching the endpoint that their technology points at. And so that's a really interesting way that we can talk to banks about doing that. And it's something that resonates with them really well, where we know you're still in the private blockchain world. We know you eventually want to go to the public blockchain world. When you do that, you're going to have to rewrite everything. Don't do that. Use our solution for a private blockchain. And then when you're ready for a public blockchain, you can just change the endpoint where you're focused. And that's a week of development instead of another year of development to do that. And so with Polymesh Private, you have things like full control, which is what banks like, obviously, enhanced privacy. We mentioned our privacy solution. That's rolling out on Polymesh Private first. And then once we've proven that in a sort of closed ecosystem, we're going to roll that out onto Polymesh. And then eventually public compatibility. So again, controlled access, native first, you give banks and custodians the ultimate flexibility, and a simplified integration where, again, banks really like APIs, they really do not like smart contracts at this point. And so whether you're choosing Polymesh or Polymesh Private, we have a leading Rust expert, the creator of ERC 1400, and the cryptographer behind the world's first account-based privacy-preserving cryptographic protocol. So that's it from me today. We're hoping that people will move beyond experimentation and use something like Polymesh to get to that full-fledged, exciting use case future where we're going to see those trillions of dollars of assets. I have my email there. Hit me up anytime. You can also find me, LinkedIn and X. I'm very, very on there all day tweeting or posting. I guess you can't say tweeting anymore. But yeah, happy to talk to anybody anytime. Thanks, Gabriel, for having me, and thanks, Klaus, as well.
Thank you, Graham. I think your description of what happened to institutional wallets that held BUIDL is one of the funniest moments of the DigiShares webinar history. So thanks for that. But we do have a very specific question for you. Can people use USDC on Polymesh? And if not, when is the functionality coming to Polymesh?
So we do not have USDC today. And so we talked to a bank recently, like one of the top 5 banks in the US, and they said they won't touch USDC. And it's not that necessarily they aren't considering eventually custodying it or handling it, but it's today in a securities settlement, they would not use USDC for the cash leg of the transaction. So a lot of banks and a lot of asset managers, they still want to use US dollars for the cash leg. Eventually we do want USDC, obviously, we want USDT as well. We have USDS from Stably today, which for, let's call it like the retail user, and for some fintech platforms, they might be comfortable using that. But still what we see a lot is banks and custodians want to do a cash leg of the settlement. They want to put what's called a payment receipt on chain, and that affects the movement of securities from wallet A to wallet B. So they still want cash.
It's really interesting because I heard of regulated players that not wanting to touch USDT, but I always saw USDC as the more accepted stablecoin. So do you think what's going to unlock this market is a central bank digital currency, or how do you see things evolving on that front?
I think potentially. I think one of the reasons why USDC and USDT aren't used much in what's called like institutional security token settlement is just the regulation is still a little bit uncertain. And so that's just one reason why a lot of banks just don't want to touch it. I think that will change. I think that will change, a couple of years from now, 5 years from now, and USDC and USDT will be involved in transactions the same way dollars are. Just a lot of banks aren't quite there yet. Well, like this bank that we were talking to, they said they would maybe touch JPM coin. And that was still a maybe for them. Like that was like, we won't touch it yet, but maybe in a year or two, like we will. And so it's just, question marks are like the bane of banks' compliance team's existence. They hate questions. And so where anything is even the tiniest bit not certain, they just won't touch it because they can't ruin their massive business and their good relationship with regulators.
Yeah, and the good news is there is legislation in the U.S. House of Representatives, right? So that may change soon.
Hopefully, yes.
Yeah. Great. Thank you so much, Graham. Again, so we're going to shift to the fireside chat, more open discussion. We have quite a few questions in the Q&A. There were a few along the lines of, I have this tokenization project in this sector. What are the key attributes that issuers, that companies should consider in terms of choosing a blockchain? So we're not going to go like in detail on each of the categories because a lot of them were addressed in the different presentations, but I think it would be great to agree on a checklist with just the names of the main categories of things to look for. So I started to write one, and then I'll post it in the chat. And so I wanted to see if you agreed or not, and if you wanted to add to the list. So I have 5, actually 6 elements for now. The first is public versus private. Second, permissions versus permissionless. Third would be proof of stake versus proof of work. Fourth, native functionality versus smart contract enabled functionality. Fifth, ecosystem strength. So things like compatibility with platforms and number of users. And finally, gas fee levels. First of all, we'll go around the table. Do you disagree with one of these categories? And then I'll ask you if you want to add more categories. So I guess no major disagreement there. Okay, perfect. So now, does anybody want to add categories to that?
Yes, federated consensus to the consensus models.
I'm sorry, could you repeat that?
I think I understood that the only 2 options given were whether using a proof of work or proof of stake consensus mechanism. And I think that the federated consensus is the most proven consensus model in traditional finance. It's literally the one used by every single, let's say, trusted intermediary, trusted financial institution in traditional finance. Even central banks are federations of members. So yes, I would like to put that one on the table.
Perfect. So I just added that. Does anybody want to add any other category to this? All right, so great. I'll copy paste the list in just a second. I'll move on to the next question in the Q&A section. So there was a question about the top use case for tokenization. So Howard listed raising capital, cap table management, streamlining transfer operations, settlement execution. What do you think is like the number one aspect that equity tokenization is going to change? I guess we can start with Anthony, for example. Well,
I'm sorry. Yeah, coming off the mute button. So sorry, the question was around equity tokenization?
Yeah, but you can address tokenization in general. Like, do you think it's going to impact capital raising more, or cap table management, or transfer settlements?
So, I mean, the revolution is going to come asset class by asset class. There isn't going to be a big bang, I think. People are going to have to solve problems related to each specific use case. And yeah, there have been a number of studies. The BCG World Bank one came out with some good ones, and they thought bonds would be among the first one, which I agree with. Private credit is also there. Yeah, private funds are harder because you have all the issues around the PTP, publicly traded partnership. This is all in the U.S., obviously, very U.S.-centric issues there. And then public equities aren't going to come on chain anytime soon. Obviously, you can't have a cap table on a public blockchain according to the SEC, although there's no specific rules. They still do need to have some clarity around that. So again, solving asset class by asset class is the way forward. We're working with a firm called Infinio. They've just tokenized about $200 million of whole life insurance policies, and they're tackling that industry. They're essentially following in Figure's footsteps. They're doing a life insurance line of credit and ledgering a policy using the encrypted object store to keep the PII off chain, using the in-place hold module to perfect ownership in the asset, and then using the asset as collateral to take out a loan with USDC. It's essentially a different asset class following the Figure playbook. So non-security assets, I think, scale first. Security assets, which are obviously more complex, will come after that.
Great, thank you. Maybe Colin, if you have a comment.
Yeah, I probably also, if it's equity specific, it's tougher to address, but I'll share, I think, what I see in terms of adoption for tokenization. For us, we've seen a lot of fund tokenization. And the play there is, here's a good article for people to look up. It was the Bain and Company report, where they gave a number of $400 billion in revenue for alternative asset managers. So it's really the idea that you could be a private equity or a hedge fund manager, and for the first time, you could sell through the big wirehouses like JP Morgan or HSBC globally with unit numbers much lower than previously. So the model is blockchain saves you costs, right? So essentially Hamilton Lane goes from like a $5 million minimum down to a $20,000 or $10,000 minimum. And thereby you get a much broader distribution of people that you can sell to. And thereby you can increase your revenues because you have access to more people by potentially double digits, right? So if you're in the private equity game, I mean, maybe you're growing like single digits, but some of these places would model a growth of, call it like 10% based on transitioning their distribution model or adding blockchain to their distribution model. So I think the numbers are really huge. In terms of total wealth, the model is something like there's $300 trillion in the world. Half of those assets are owned by individuals, so 150 trillion. Out of that 150 trillion, there's almost no allocation to private equity or hedge funds from the investor base that owns individuals that own between 1 million or have 1 million and $30 million of investable assets. Because of the high minimums that currently exist in the market, it just doesn't make sense in terms of asset allocation and suitability. So that's a big macro picture. The bottom line, and therefore you, I guess, arrive at a number of $30 trillion that could now be accessed by transferring these kind of private or fund ownership assets to a blockchain Rails model, and therefore getting that $400 billion revenue opportunity that currently doesn't exist. So the short, sorry for the long-winded answer, but what I see is tokenization of funds really taking off. Use of money market fund style instruments on chain as collateral, that I think is going to be the massive narrative for 2025. So if you're a settlements person and you're talking about Wall Street settlements and the ability to use a tokenized asset instead of cash, USD, which requires transfer sometimes to multiple parties in multiple days, especially depending on whether or not you're going cross-border, using blockchain for atomic settlements, that to me is like a massive market that I don't think a lot of people are paying attention to. And then beyond that, you probably get private credit 6 to 12 months out, and eventually you get to equities.
Super interesting. Thanks. Maybe Adolfo. Yeah.
Yeah, thanks. I will repeat what I said in the presentation. I think that the biggest problem, many countries, we tend to look a lot to Western countries. We are West-centric, right? When we analyze how a blockchain can solve problems. But what I see is that the institutions in the EU and the US work pretty well. You know, they provide this trust. They are not that efficient, but they provide the trust needed to make sure that the rights and obligations of an asset are actually enforced, that the ownership of each asset is you know, everybody knows what asset belongs to whom. But that doesn't happen in most emerging countries. That is not the case in there. So even if you have a reputed law that provides very strong legal security to valuable assets in those countries, there is no way, there is no trusted intermediaries that connect those valuable assets with global investors. And this is the kind of use cases that we see growing a lot on Liquid, and the ones where we are betting on, because we realize that one option is like the ones that I hear commenting here and in many events, which are to improve the efficiencies. Okay, but since the liquidity in blockchains is very small compared to TradFi, chances are somebody that is looking for liquidity will not come to a blockchain, right? It will not be solving much problems. But for many valuable assets in LATAM countries, for example, there are many non-banking financial institutions with very limited access to capital. And those are people have very valuable assets in their balance sheets, and they are tokenizing them now to be used as collateral to keep borrowing money, to keep their lending operations ongoing. So that's where I see a huge market developing, and I look forward to keep pushing it.
Super interesting. So you think, yeah, the emerging markets could leapfrog in a way over developed established country markets because of this. I'm guessing it mainly has to do with the trust issue, and that's why they would use the technology to.
Totally. What is the most successful use case in a blockchain? It is Tether. Tether is literally connecting the US Federal Reserve, the most reputed institution probably in finance, with users worldwide that don't enjoy the rule of law of the US, because there are no trusted intermediaries, or the trusted intermediaries have very limited access to US dollars. So this is literally the problem a blockchain solves, in my opinion, because it's like a consensus on what the truth is, digitally speaking. So once you turn those assets into digital with a reputed institution in the origination, you can turn them into you know, valuable assets and with enforced rights for the end investor. So that's the way I see it moving forward.
Super interesting. Thanks. And Graham, on these use cases, anything to add?
Yeah, I'll echo kind of what Adolfo was saying, where one thing that we're very excited about right now is carbon credits. And it's because, you know, as Adolfo was saying, Western markets work pretty well. I know how to go buy Apple stock. I go click some buttons on my computer. It's pretty fine. There's a well-worn path of liquidity for those types of instruments in those countries. And there's a well-worn path for a company to go raise from venture capital, go to an ABC, and then go public on the New York Stock Exchange. You know, that works pretty well. But where would you go buy carbon credits today? Like, I don't know. I don't know the established liquidity venue for carbon credits. So these kinds of markets where there's new interesting use cases and new interesting assets where there's not really an established liquidity venue, I think that's one place where they're going to leapfrog the existing technology, and they're going to go straight to blockchain, like the same way, you know, Africa leapfrogged telephone lines and they all just went to cell phones. And then just to touch on, I think part of your initial question was about like the specific area that's interesting about like equity tokenization, but for kind of any tokenization. So one of the reasons why I got so excited about tokenization in the first place, one of my summer jobs between third and fourth year university was working at a bond fund. And my job, I would come in the morning and I would look at our spreadsheet that we had as the fund. And then I would look at the custodian's spreadsheet that they had on their portal. And sometimes the numbers wouldn't match, right? So like sometimes we would get like whatever, 100.2 of a distribution, and the custodian would only give us 100.1. So I would pick up the phone and I would call someone, and then I would figure out, hey, what is the proper state of the world? What is it supposed to be? Is it 100.1 or 100.2? And then we'd go, and then we'd do some calculations. Then we'd say, okay, yes, your spreadsheet is right, or my spreadsheet is right. Like that makes no sense. Like in the world of the internet, in the world of blockchains, where you can programmatically enforce these kinds of things, where things are 100% automated. Like that's what's really exciting for me, is like not having some stupid kid like checking spreadsheets to make sure that the world is right. Like it just happens automatically. And so eliminating a lot of this weird friction and problems in back offices where the world can function more efficiently and in a more automated way, I think that's something very exciting.
Yeah, I had a similar experience in a public sector investment fund where the middle office would print the different capital calls and transactions, and if there was a discrepancy, like I had to alert a certain person, or so it was,
Yeah.
pretty crazy. Then you'd go into the middle office room, and there was just paper everywhere, and they were crumbling under all that. So yeah, definitely hear you on that. No, thanks to the panel for answering that. So we have a question from Rada about NFTs. What is, I mean, my generic answer to people is that NFTs aren't really compatible with securities. Does anyone disagree with that? And if so, why?
Yeah, so I'll jump in. So, NFTs obviously get a terrible name because of the cartoon monkeys smoking cigarettes. But every figure loan that is spun up, every Infinio life insurance that is spun up is an NFT. It's a non-fungible token. And the way that we make them work and the efficiencies of a non-fungible token is you obviously create the non-fungible token on chain, but the encrypted object store that I mentioned, for when you take out a HELOC, you have a servicing report, your first lien mortgage, your property condition report, the video notary session, right? You have a ton of data that backs the NFT. So all that data sits in an offline encrypted object store. Each item is encrypted, and each item gets its own hash. That hash is written into the actual NFT. So when that NFT is issued, it's then warehoused, so that's a sale, and it's then securitized, which is yet another sale. But the rating agencies on the figure stuff have opined that they don't need to audit each one of those steps because the original hash representing the video notary session, for instance, is cryptographically proven to be true. And unless that hash is invalid, which if something changes in the encrypted object store, the hash becomes invalid, only then would they have to go back and audit it. So Figure has reduced audit costs by like 95% off of the process from issuance to warehouse to securitization. And the amount of time and money that saves is material. Obviously, cost of capital is significant these days. So that's a lot of the cost savings and efficiency savings behind what Figure's doing. But again, it's an NFT. It's not a monkey smoking a cigarette, but it's an NFT.
Yeah, that's really interesting. But so is there an additional layer of security tokens on top of the NFT, or
so the NFT can comprise the ABS. So the ABSs have been comprised of all NFTs. So the underlying assets are all NFTs. Large, and we talked about this a bit. So until stablecoins are solved, which they're far from, you're not going to see massive amounts of hundreds of millions of dollars of value being transacted on chain by institutions because, as one of the participants said, banks aren't using USDC. KKR buying a $300 million tranche of HELOCs is not going to fund in USDC. They're just not. They're not going to take Circle, private company risk on a stablecoin. They're going to send a wire. So the ironic aspect of the Figure assets is they're digitally in, so digitally native created, and analog out, meaning the ABS is underwritten by Goldman Sachs and JP Morgan and Jefferies, and BNY Mellon is the indentured trustee. A lot of that is still that way. So they're moving more and more to digital out, so digital in, digital out, selling tranches of individual ABSs. But right now, most of the ABSs have a CUSIP number to settle at DTC. Until stablecoins are fixed, and if Figure's yielding stablecoin, if you go to Edgar and search for Figure Certificate Corp, it's a face amount certificate. Hopefully in its final stages with the SEC, but it'll be the first ever yielding stablecoin that can be used as security, backed by the SEC, bankruptcy remote, everything that you would want out of a stablecoin. That would start to change the industry.
Super interesting. Colin, any comments on this, or anyone else in the panel? Yep.
Yeah, no, what Anthony said is actually dead on. It's like the thing that you probably wouldn't think about. By the way, I don't know if those are cigarettes that those apes are smoking. These NFTs can wind up representing financial assets. So that's the loophole there that would go against your kind of your initial statement, Gabriel. And we're seeing a lot of that too.
Interesting. Yep. Adolfo.
Yeah, I totally agree with what Anthony said. Most of the use cases, if we isolate ourselves from the monkeys, I think NFTs make total sense. Promissory notes, factoring for invoices, lots of warehouse receipts. Many titles of credit coming from LATAM are actually NFTs. And the way they work is literally how Anthony described it. It's by basically linking cryptographically the token with the information stored in some reputed fiduciary, for example. And that way, the law can enforce that the owner of the token is the actual owner of that title of credit, that document, that loan, whatever. And so, yes, but it's an NFT indeed. It is a non-fungible token. So yes, I think we need to get further away from this monkey idea and understand that if it's a non-fungible token, there are many applications indeed.
Yeah, I'll add to that where an NFT can be whatever you want. It can be a picture, but it could also be a picture where there's some type of royalties associated with it. It could be a song, but also have some type of ownership over the royalties of that song into the future. It could be a mortgage. It could be title that represents ownership to some piece of property. So really, a token is a token as far as the blockchain is concerned, but it's really like what legal information or designation do you inject into that token, and what contracts are people signing to create it and into being an actual, real thing beyond just a token that exists and can be, sent and received. And so, yeah, we've seen a ton of different applications. One is actually that music NFT, where contracts can actually be legally enforced on chain, where you can force royalties to actually be sent to the original creator of the music. And so that's something that we're pretty excited to be seeing very soon. But yeah, I think we're going to eventually move away from the term NFT. It just has a lot of baggage associated with it. Same way we don't really call them security tokens anymore. There were STOs and security tokens, but then people thought that was too much like ICOs. And so then they were tokenized assets. Then they were real world assets, but the finance people don't like real world assets because that's risk weighted assets. And so they don't like RWA. So, ultimately, the ultimate goal is like for it to just be securities, and just they all live on blockchains because it makes more sense. And they're just going to be, a mortgage that just happens to live on the blockchain. It's going to be title that just lives on the blockchain because that makes more sense. So I think eventually we'll get rid of kind of the NFT nomenclature.
And if this mortgage or title, even if it's an NFT, is fractionalized, does that mean that you need like some other layer on top of it, or how do you see this?
So you could have kind of like, then it is fungible kind of, but what you can do is you can create a set of NFTs where you create, the mortgage or you create the title, and then there's like 100 different ones, but they're numbered. There's 1, then there's 2, then there's 3, and 1 is not the same as 2, is not the same as 3, all the way to 100. And so you can have, fractionalized NFTs that are still unique and non-fungible.
Super interesting. Yeah, learning every day. Even though I've been in this space for years. Just going down the Q&A, there's another great question about the ability to transfer tokenized shares between blockchains. So, we have 4 chains represented here. What if, someone wants to maybe switch between chains? Maybe there's an exchange or a platform that's not compatible with one chain but is for another. Like, how do you see that problem being solved, if at all? I guess we'll go back to Anthony and go down the list.
Yeah, so 2 ways, I think. So the bridges do a wonderful job of moving assets across chains. When we did Project Guardian with the 3 different chains, it was Onyx, Digital Assets, and Avalanche, and they're all private permission zones, of course. Axelar moved from Provenance, and then I think Layer 0 moved from Avalanche. And it worked smooth. Of course, bridges may not be the ultimate solution. There have been some hacking and some other things over time. What Figure Markets does is interesting. So MPC wallets are emerging technology in the space, multi-party computational wallets, which shard out ownership of your keys across networks. But they allow, so for instance, if you trade on Figure Markets, you trade Bitcoin, it's native Bitcoin. If you trade ETH, it's native ETH. You can trade USDC, ETH wrapped USDC, or Cosmos Provenance wrapped USDC. and these MPC wallets can hold all these assets. All these assets can trade on a decentralized exchange. So I don't know that that works for securities, but certainly for non-securities, that construct works really well. And I think as you know, the functions of wallets, the functions of bridges, even most of the functions of generic blockchains get abstracted away from user experience. This is where I think my thesis of an oligopoly of blockchain providers comes into play. I think we have a very small number, and again, maybe hopefully it's four. It's the four here today, where that are all interoperable with each other, and that's where the majority of the world's financial assets sit and settle.
Great, thanks, Colin.
Yeah, maybe this is the one contrarian thing that I'll say on the entire call to Anthony. We actually don't believe that bridges are very secure. I think at Polygon, you take the view that over the last 2 years, if anything, all the hacks have proved is that they're really not. So our solution to that was really to bring all of our ZK zero knowledge teams together. Polygon spent about $1 billion to buy various I would say the best of breed zero knowledge startups. And we combined them to form a product called the Ag Layer, which I mentioned. So what this product does is it moves native assets cross-chain. So the idea is, yeah, you can move tokenized security assets from, in a future state, call it Avalanche to Solana, using zero knowledge rails, have very little, if any, in the way of trust assumptions. So it becomes a very different world. By which within one click, without knowing you're going cross-chain, you could, as just an example that I think these names resonate with people, that's why I use like Solana and Avalanche. You could take liquidity from Solana and use that liquidity to do a DEX transaction on Avalanche in under a second, not knowing you're going cross-chain. And so the user experience winds up becoming much more like the internet, right? Like Web 2. As opposed to a silly example, the early internet. I was around in the late 90s when say you had Amazon and eBay as the major players. What that would look like in Web3 terms is you have your eBay token and you bridge your eBay token over to the Amazon token. Maybe you get a wrapped Amazon token, and it's like a user experience that I probably couldn't execute, let alone my parents. And so that's just not the user experience that will get us in the blockchain space, the next 200 million users, let alone the next billion users. And so the idea there is to move assets cross-chain in a very secure way that entails a user experience that looks a lot more like the internet today.
Great, Adolfo.
Yeah, as I said before, I think that the problem this solves is the lack of, when there is lack of trust, a trust minimized enough, blockchain can solve problems. So I think that the most trust minimized blockchain is the one that will accrue liquidity by solving problems the most. And so the way we've built it is what I explained in the presentation is by enabling formally verifiable smart contracts, right? If you can be sure of a computation, you can make sure that another blockchain can, you can ensure that the tokens locked in here can be unlocked in there, but unfortunately for other blockchains, formally verifiable smart contracts are not possible on non-UTXO model blockchains. So that's why we bet everything on Bitcoin-like blockchains, basically.
Thanks. Graham?
Yeah, for me personally, like interoperability is like a problem for securities we don't really care about yet, or at least I don't really care about it yet. Like we still have to like solve the initial problems. Like let's call it like in, I don't know, like inning 2 of securities on blockchains and interoperability to make sure like all the different blockchains talk to each other and can like establish relationships with a bridge or whatever it is like inning 5 or something like that. So for me, it's more like let's get to $5 trillion of assets, and then let's figure out how all the assets can move around on their individual blockchains. But I think how will it come together? It'll be some kind of layer that sits on top of blockchains, and I don't know if it's called a bridge or if it's something else. But for me, it's like let's solve the other stuff first, and then let's worry about how all the blockchains can communicate and all the securities can function on different networks.
Thank you. I did want to ask you guys about thoughts on Ethereum. I know it's been mentioned here and there, but if we could just give a clear answer as a panel on the pros and cons, because there have been questions. I mean, I hear them all the time. People see that it's the most widely used chain for tokenized securities, and they're wondering, whether they should just use the L1. So of course, there's the gas fee consideration. Would love to hear your thoughts about the security aspect, and maybe we can have this debate here, and just maybe some things to keep in mind about Ethereum that would make maybe Ethereum maxis think twice before choosing it. So I guess Anthony, if you could summarize your thoughts on that.
Yeah, I don't know, how building on Ethereum is. Yeah, I'm not an expert on it, so I can't speak with any authority on what the experience is like. Going back to the use of smart contracts that we've spoken about, I just don't think that's the way forward for regulated financial services at scale. I think the network does need to be more purpose-built, and I think you need to abstract away as many smart contracts as possible. And what I know about Ethereum is it's a very smart contract-based blockchain. Not to say it isn't perfect for many other use cases. It's just regulated financial services, I believe, requires a bespoke blockchain with all of the attributes that I discussed in my presentation, because regulated financial services is a very different use case than most other things going on in crypto land.
All right, Colin, I guess your answer may be a bit nuanced compared to a bit different, but yeah, I'll let you address the Ethereum topic.
Yeah, this is the topic du jour in crypto. Has Ethereum essentially lost its mojo relative to either application-specific chains or the alt layer ones? Right now, I think the narrative, there's a big question, like, is Ethereum, kind of the main vehicle by which a lot of this gets done? And the answer for the market right now is increasingly less in agreement with the idea that Ethereum would be. But having said that, I think the narrative kind of goes in waves, and sometimes it's Ethereum on top in terms of narratives, and sometimes it's others that kind of gain in terms of the prevailing narrative at the time. Using Ethereum specifically for security makes a lot of sense for a lot of reasons. I agree with Anthony that the rest of the package of Ethereum may not be the right one for regulated financial institutions. And that's where you really get layer twos or app-specific chains. You can connect private permission blockchains to Ethereum. So as a global settlement layer for Polygon, it still makes sense. And I want to address before Adolfo gets on that, one thing I love about blockchain is that it changes like, daily, if not minute by minute. And I love how I made a comment and I was violently disabused of my notion like 10 seconds later. But that's science, right? It's like, actually, you have to be very humble and know that the 4 chains on here have launched products with ideas around product market fit. And the reality is none of us know if this is going to be the solution 5 to 10 years from now. And one of the really cool things about the industry is people are just really willing to go all in and innovate the hell out of it and learn from each other and understand that it's an iterative process. And we all take ideas from each other as we see things that are working better or less well. And so I think a lot of people like, oh, I want to see the war between the blockchains and things like that. And I don't really think of it like that. It's really an industry that it shares a view that this is a technological alternative that is an order of magnitude better than the prior solution. And it's just, I think that's what we all rally around. And we fight for various ideas, but we are constantly wrong in the market all the time. And the reality is, just to kind of sum up, Adolfo is actually correct. Bitcoin does have the highest security of all the chains. The reason I didn't mention it, and I don't usually think of it in the context of my comment, was that the challenge is one of technology being able to export that security. There's a lot of excitement around Bitcoin layer 2s. That according to the VCs that I talk to, that could be like the next generation, really fascinating evolution for crypto. So I would argue that that's definitely not incorrect. It's more of a question of the technology sussing out how we can actually bring that to the masses and make it viable.
Thank you, Adolfo. I guess anything to add?
Yeah, I mean, I will repeat again something I said in my presentation, which is that if you try to enable all use cases in one chain, then you are unlikely to cater to any of them. And that's what I think the problem has had, Ethereum has had at all times. It's the fact that it wanted to have a valuable token and at the same time enable financial applications with way too expressive smart contracts that have as a trade-off not that much security. And therefore, yes, it has had a great success in enabling lots of use cases where perhaps security was not that important. But when it's about moving hundreds of millions in one transaction, I don't think, you know, and for example, things that I commented in my presentation that invalid transactions get confirmed or that MEV happens all the time. These kind of things cannot happen in the financial industry, and cannot happen either in emerging countries where there are no regulators that, you know, tell you what to do when things break, right? Things cannot break, should not break, you know, and they should work in an autonomous way. And that's what the kind of things we like building, you know, using that trust minimization philosophy from Bitcoin. That I think is the problem that solves. It's just that formally verifiable smart contracts is a project that took us 7 years, you know, and so these things are very hard to build. Things that actually are trust minimized and with hardcore security principles, right? So that's why I think that if you want to enable these high value, mature financial applications, perhaps Ethereum is not the right choice.
Thanks. And Graham, I know you had a detailed slide as well on the topic of why, you know, why not Ethereum, but maybe just summarize in a few bullet points before we wrap up.
Yeah, so our dev team hated Ethereum is like the easiest way to say it. Like we were one of the first teams building standards on Ethereum, and we absolutely hated it. I think if, you know, Vitalik and co back in 2014 realized how important tokenized assets would be on Ethereum, they would have constructed it entirely differently, you know, like, but instead they were walking around conferences with shirts that said decentralized Uber in one line of code. You know, like that's what they were thinking about at the time. They were like, Vitalik was thinking about, you know, how he can have like his war. What was it? Was it Diablo? I think it was Diablo gold that he got, you know, taken away from him. Like that's what he was thinking about. Whereas now with, you know, Polymesh, Polygon, Provenance, Liquid, all these other new chains as well, we are only focused about how do we, you know, make capital markets more efficient. And so you just come at it with such a different set of design principles, and you make a lot of different decisions for how you build the network that you just wind up with a completely different solution. And so, yeah, there's, you know, gas fees on Ethereum. There's the fact that there can be a chain split. It's totally permissionless. So with BIS rules, maybe you can't have a huge amount of your capital base on it. It's smart contract focused. So you're potentially relying on third parties to do basic things like asset creation and trading. But yeah, like at the end of the day, there are a lot of networks with better design characteristics and with better features and functionality for this specific asset use case. But at the end of the day, like Robbie Mishnik, who's like head of digital assets, is like a buddy of mine. And like, so my hand's broken right now because we play hockey, and I broke my fucking hand when we were playing hockey 2 weeks ago. But so like I asked him, I was like, well, like, why didn't you guys, you know, even consider Polymesh or like something for the middle fund? And he was like, well, Ethereum is the biggest. We had to do Ethereum first. Right. So like that's still where people are. It's like kind of in this like 1980s, 1990s thing. Well, I had to use IBM because I won't get fired if I choose IBM. You know, and so like we're still kind of there. But I'm hoping things will change pretty soon when people start to see, you know, networks like the ones that are on this webinar take more shape, get some more wins, get some more assets under our belt, and then, you know, it won't be such a hard decision, Ethereum versus something else.
All right. Well, hopefully you don't play hockey with him just to convince him to use Polymesh, because that would be a big sacrifice.
No, we're buddies outside of that. But yes, I'm off the ice at least for another, I think, 4 weeks before this thing heals. But yeah.
Sorry to hear. All All right, guys. I think we'll end 9 minutes early. We were super efficient, unless anyone has anything else to add before we wrap up. I guess that's a no. Thank you, Anthony, Colin, Adolfo, Graham. This was a wonderful webinar. And thanks to all who have joined and who will be watching this on YouTube once the recording is out. And yeah, see you next time for the next month for the DigiShares webinar on tokenization in Europe.